Hello, my name is Veronica Saldivar, and I will be sharing how you can add commercial real estate to your investment and retirement portfolio. Kaaren Hall is also here, and she'll explain the how-to of using a self-directed IRA. I appreciate your time and willingness to learn about this amazing wealth-building strategy. You've already made the first and most important valuable investment, which is your time, so let's be sure to maximize it. This webinar is for people who are interested in learning about passive, high-yield, turnkey, done-for-you apartment building investments. It's for people who have an interest in having an expert guide them in growing their retirement account and net worth in a hassle-free investment platform. Lastly, it is for people wanting to learn how to invest their IRA outside of Wall Street. First, I have a couple of important announcements before we dive in. If you stay till the very end of the webinar, I will send you a gift to increase your real estate investment knowledge. It's a color PDF guide that illustrates the real estate market cycles and when to buy and sell depending on key market indicators. This alone is a powerful tool that can help you tremendously, so be sure to stay until the end of the webinar. Number two, I'll ask that you hold on to your questions because you can ask me directly. I will share how you can book a 30-minute discovery session call with me at the end. On this webinar, you can expect to learn the following: basic principles in commercial real estate investing, factors I use to help identify strong investment markets, and how I select a property to invest. But first, let me explain and share a little bit more who I am and why I do this. I grew up in Southern California and have lived here most of my life. Aside from about 4 months I lived in Argentina, and a year I spent in flight school. At the age of 18 years old, I started flight training at John Wayne Airport. After my first flight, I knew what I wanted to be when I grew up. I was going to be an airline pilot. After a few months after my 19th birthday, I had my pilot's license. I am often asked, does anyone else in your family fly? The answer is no. I just thought it would be a cool thing to try. While attending Cal State Fullerton, I worked as a teacher's aide, and after I graduated, I went to become an elementary school teacher and taught kindergarten and 3rd grade. It was a great fit for me. I loved teaching and had afternoons free to study and continue my flight training. Soon I had completed my commercial pilot license and certified flight instructor licenses. After 3 years as a teacher, it was time for me to move on and pursue my dream of becoming an airline pilot. I resigned from being a teacher and became a full-time flight instructor at John Wayne. I absolutely loved it. It combined two of my passions, teaching and flying. I had a smile on my face every morning as I drove to the airport. Soon I had 1,500 hours of flight time and was officially eligible to apply for a pilot position with the airlines, but something made me hesitate. I was officially eligible to apply for a pilot position with the airlines, but my friends were telling me how horrible the pay was and the work conditions had become. In the process, I was in serious credit card debt and had student loans and made less than $18,000 as a flight instructor. One morning, while I was ready to hop in my car and head to the airport, I ran into the owner of an apartment complex. The property manager introduced me to him, and I remember thinking to myself, I want to own apartments too. Something in my life had to change. While I was ready to apply for the airlines, I realized that I'd need more. So I decided to stop pursuing that airline career. To be honest, it was a really low point in my life. I had invested so much time and energy into something I was walking away from. Have you ever felt this way? You know there's a better life ahead, but you're not quite sure how to get there? I had to ask myself two questions. At a major fork in the road, I had to decide what to do next. In 2004, it was all the rage to be a mortgage broker and realtor, but I had a feeling all the good times and fast money wasn't going to be around for much longer. So I researched other opportunities that would have a stable and longer-term outlook. I specialized in the financial services industry with small to medium-sized businesses and helping them cut costs. Soon I had mastered the business and was paying off my debt quickly, as I was back on my feet on no time. The next question I started to ask was, what's important to me? After a couple of years, I started my own office, and I was building my business and becoming more financially secure. I had plenty of free time to spend with family, and I could take care of my 6 family members and fly to Texas to spend 2 weeks with my grandmother before she passed away. I didn't miss any soccer, basketball, dance recitals, or school plays. Giving back, both time and money, are important to me also. I've raised funds for the American Cancer Society, donated funds to the Santa Ana School District for books and field trips. I've developed a sports program for a youth center in South Africa and funded outreach to at-risk youth and adults in high school juvenile detention centers. And most recently, I helped to fund a documentary called Triggered to help people suffering from PTSD. I've also volunteered for my church for both local and international projects, and I currently serve on the board of directors of a nonprofit that is making an impact both nationally and internationally. While I was contributing to my community, I grew my business into a multi-million-dollar enterprise. Upon the launch of my business, I had a very clear exit strategy. I would eventually build and sell another one. A couple of years into the before the sale of my business, I prepared for a major liquidity event and learned how and where to invest my funds. In 2010, I began to ask myself where I should invest my money. I found the answer and began to invest. I was on a mission to become a savvy investor. I began to read books, attend seminars, and seek highly qualified and experienced mentors. It was a process that took a tremendous amount of time. In addition, I sharpened my business skills, attending an intense business consulting training, and enrolled in a rigorous business building coaching program. This is still a process I follow today. I recently graduated with my master's in business administration and soon will complete coursework to be a registered investment advisor. I followed a specific process and strategy to become a successful investor. I will share some of what I have learned now. So why apartment buildings? Why not single-family homes? After all the methods and markets that I researched, the answer was very clear: commercial real estate. Commercial real estate includes office space, hotels, retail shopping centers, medical buildings, and public storage facilities. But I decided to focus specifically on multifamily apartment investments. This asset class is one of the top performers in commercial real estate. In fact, there are 8 reasons why you should invest in multifamily real estate. The first is less competition. The average real estate investor will start in their own backyard, purchase single-family homes, and they'll hold it long-term and rent it out, or perhaps sell it after they've rehabbed it. The next step is to move into a duplex or triplex, but unfortunately, this business model is competitive. More recently, these investors are competing with hedge funds, international investors, and even all-cash buyers. There's a lot of competition. If you apply the buy and hold or flip model to apartment buildings, there's less competition and you can multiply your profits faster. The next reason is cash flow. Everyone is in real estate because they want cash flow. And they want their properties to produce it. Multifamily properties produce cash flow from day one and continue to increase cash flow year by year. When a single-family home is not rented, the owner is out of the rent for that month, out of pocket, or even perhaps out of pocket for several months. However, when a multifamily unit is not rented, the other units continue to pay so that you're still earning this steady cash flow. There's less work involved. Once a property is closed, you set forth a plan of action and there are weekly reports to review, but the work as far as the clogged toilets, leaky roofs, and slow rent payments are all handled by professional property managers. You can enjoy a higher quality of life without the headaches of being a landlord. Economies of scale. With a single-family home, you have one rental unit with one roof. In a multifamily situation, there are many units under one roof, so on and so forth. It's just cheaper and easier to own a multifamily. Also, supplies can be purchased in bulk at wholesale costs. You're not limited to owning in your local region, and this is one of the most important factors. The theory behind my strategy in multifamily ownership is to buy where it makes the most sense and where the returns are the highest. You can choose where to live where you want, but by following the best markets in the nation during the best market cycles, you can increase your return on investment. The next, there's less risk. You're financed on business income. Multifamily property acquisitions are based on the income and performance of the property. Personal finances do come into play, but only as a point of reference for the character and the purchaser. But when you're buying a multifamily real estate, the purchase is going on the actual performance of the property itself. Next, the growth cycle. And this is actually probably the most important factor. Market timing is ideal. It's a great time to invest. So the question is, why now? The U.S. rental marketplace is experiencing one of the largest growth cycles in commercial multifamily history. The housing crisis and overall economic downturn created a huge slowdown in construction and development industries. According to a recent Bloomberg article that was just published this week, the American dream now includes a lease, not a mortgage. In this article, 52 of the 100 largest U.S. cities were now majority renter in 25, per the U.S. Census data that was compiled for Bloomberg and Redfin. 21 of those cities have now shifted to renter domination since 2009. Further compounding this scenario is the coming of age of 80 million millennials. This demographic is now just beginning to graduate from college and form their own households. Add that all together and you have a recipe of demand in a rental housing market without the adequate supply of inventory. So far, we've identified the reasons why multifamily apartments are a strong investment platform, why the timing is right. Now let's look at where I invest. I look for emerging markets in simple terms. I search the entire nation and study many factors. One of the most important is job growth. In fact, it is a fair statement to say that I follow the jobs. Where are the areas of job growth now? They're in North Carolina, South Carolina, Georgia, Utah, and Texas, just to name a few. These are all examples of emerging markets where it is likely to find an investment property. Multifamily units operated in emerging markets tend to have higher occupancy because emerging markets tend to have more jobs being created. And where the jobs go, people go. And people need a place to live. It's a simple formula. How do I select a property? I purchase underperforming assets. My strategy is to acquire, manage, and operate stabilized multifamily assets that generate strong, attractive cash flows. My focus is to provide investors with sound, opportunistic investments, and the location and property selection are the two major key factors to make this happen. Increasing the property value and decreasing expenses, improving operational efficiency and increasing rents due to being below market average, and also decrease expenses. And of course, all of these items are adding up to increase the net operating income. Before the rent increases begin, I make sure that the value is being added to the property and all is in great shape. The most popular amenities are building out a dog park and a splash zone for the kids and adding new playground equipment. Let's look at a classic underperforming property case study. This complex was 125 units, and the approximate purchase price was $4 million. It was in the Dallas area. The owner had over 10 apartment complexes, and he was overextended. He needed some cash to continue building his new project that had stalled due to the lack of funds. So in other words, he needed to sell quickly and he wasn't paying close attention. So the first strategy is to increase rent. You may be asking, what exactly does that mean to buy an underperforming building? If a property is underperforming, it makes it much easier to increase the value. This building had the lowest rents for both 1 and 2 bedrooms in the comparable market. The 1-bedroom units were $75 below average. If you take the total 87 units and multiply that out by 12 months by the increase of $75 per month in rent, that'll equate to an increase in annual income of $78,300. Likewise, we take a look at the 2-bedroom, 2-bath units were $49 below market average. Using the same formula, the annual income is $17,052. The 2-bedroom, 1-bath rent was only $19 more than the 1-bedroom, 1-bath. So you have a difference in monthly rent of $572 versus $553. That's a no-brainer. Then the rents would be increased to $625 on the 2-bedroom, 1-bath unit. Here we created an additional net annual income of $8,904. The next strategy is to charge tenants for water usage. This is an industry standard practice. I can build 75% of the water bill at a cost of $15 per unit. The increase in annual revenue is $33,494. Strategy 3 is the old-fashioned cut costs, and we do that by making changes to the management program, and an additional $63,213 is saved. All of the above value adds and cutting costs help us to increase the net operating income by $200,962. Now, with the power of commercial real estate, by simply increasing the net operating income, we're able to increase the property value by $1.5 million in this case study. The next thing I look at is a motivated seller. Once I have identified the property that fits my underwriting criteria, I assess the seller and how motivated they are to sell. A highly motivated seller allows me to negotiate better purchase terms and get the property at a discount. Here are some reasons why they might be ready: retirement, illness, divorce, burnout, or in the last case study we looked at, it was an overextended landlord. So remember, I started this quest to find the best investment platform in 2010, and I began to invest in apartment buildings in 2011. In 2012, I sold my business and became a full-time investor. I wasn't comfortable with the traditional Wall Street investments. I was looking for the best place to invest my money, and I wouldn't share anything I currently invest in. So I'd like to share a few properties in my portfolio and take a look at another case study. This particular property was located on the I-35 corridor between Austin and San Antonio. It's 152 units built in 2009. The purchase price was $13,075,000, and it was later sold for $17.15 million. The holding period was 3.75 years, and if you had invested $100,000 in this particular investment property, you would have earned $203,544, making 104.9% return and a total average annual return of 28%. Now imagine this apartment building was in your investment portfolio. I also have other properties in the Atlanta area, Dallas area, and the total portfolio that I have is currently at 773 units, valued at $28 million. Now just picture it. You have a tremendous wealth building asset adding to your net worth and retirement account with no work, hassle, or debt. This turnkey strategy is all done for you. All you have to do is collect your checks. The next question is, how do you begin to invest and build your own portfolio? Now, most people can't purchase a $5 to $10 million property on their own. And even if they could, they're likely not to get financed because they might lack the specific operational experience of running an apartment building. My apartment strategy makes it accessible for everyone. Investors in self-directed IRA account holders own a percentage of the company, holding company LLC, based on the amount invested. The minimum investment is $50,000, and there are two ways that you can invest. The first way is you can use your liquid capital, and the second, you can use your retirement account. You are paid on a quarterly basis and or a biannual, depending on the particular project. You create a residual income and additional revenue streams that you can help to replace your current income needs. There are no repairs, no collections, no additional debt that you would need to take on. In simple terms, there's no work. You just collect checks in your mailbox. So as we're wrapping up, I just wanted to share with you the next steps. And thank you also. Thank you for the time for increasing your financial and investment literacy. The next steps are to sign up for a discovery session with me. Together we can find out if commercial real estate is a good investment fit for you. During the session, we can discuss your investment goals, and I'll share additional wealth building strategies and the mindset necessary to help you to live and achieve the life you've always dreamed. If you have questions for me, that's great. Book a discovery session. I'll answer all of your questions one-on-one, and I promise it will be valuable. If it wasn't worth your time, I'll write you a check. If you feel I didn't deliver on my promise and I wasted your time, let me know at the end of the call, and I'll personally write you a check for $100. But the reality is, I'm only doing it because I know without a shadow of a doubt, if you're serious about building wealth, there's no way you won't get at least 10 times the value. Go to veronicasaldivar.com/discovery to sign up for your session now. There's a limited availability over the next 2 weeks, so be sure to sign up right away. Thank you for your time, and I look forward to speaking to you soon. And next, I'd like to introduce Kaaren Hall, the president of U-Direct IRA, so she can begin her informative presentation on how to use your self-directed IRA.
Thanks, Veronica. If you want to switch over the operator there, then I will get going. Excellent.
Okay, coming your way.
Great. I so appreciate being asked to be a guest on your webinar today, and I'd be happy to answer any questions at the end, just as you are. I'll give my contact information. So Veronica was telling you a way of investing for your retirement, and so what I'm here to talk about is how to use an IRA, specifically a self-directed IRA, to invest in alternative assets that are not the stock market. So what we do at U-Direct IRA Services is what we don't do, I think, is important too. We don't offer tax and legal advice. We're not accountants. We're not CPAs. We're not attorneys. We don't recommend particular investments. So if you're looking for investment advice or tax or legal advice, you'll need to seek it elsewhere. But what we can advise you on is how to use a self-directed IRA. And that's what I'm here to talk about today. When it comes to saving for retirement, there is a huge deficit between what Americans have and what we need to retire. I think we all know this. Lots of money in retirement, though. We've put away a lot. And as Americans, we've saved around $24 trillion in retirement. Only about 3% of it is in what's called alternative assets. Now, back last April, Tom Perez, who was the Department of Labor Secretary, I think he has a different job now, but at that time he says, we've moved away from the era of defined benefit plans to a modern family universe of IRAs and 401ks. He says, so the responsibility for retirement savings is now squarely in the hands of ordinary Americans. And that's exactly what self-directed IRAs are about, is putting the responsibility for your retirement savings directly into your hands. Now, if you haven't heard about self-directed IRAs, you're not alone. A lot of CPAs and a lot of attorneys haven't heard about this either, but you've been able to self-direct for over 40 years. The IRS came out with these rules in 1974. That's when the ERISA Act was signed, and it went to effect in 1975. So 42 years you've been able to self-direct your IRA. So what's the difference? A typical IRA is invested in the stock market, pretty much. Stocks, bonds, mutual funds, maybe CDs. But with a self-directed IRA, those doors to what you can invest in are opened to include, different asset classes, such as the one that Veronica was speaking about: rental properties, notes, and private stock, and LLCs, and precious metals, and tax liens, and so many different assets that are considered alternative assets because they're not correlated to the stock market. So when your IRA is investing, your IRA could lose money because, of course, investment implies risk. And what if your IRA loses money? Well, it's super important to know that those losses cannot be written off on your income taxes, and you can verify that with your tax advisor. They can't usually be fully replaced in the IRA because we've got contribution limits. And if you have a traditional IRA, for example, your contribution limit is $5,500 if you're under 50 and $6,500 if you're 50 plus. So because you can't write them off and you can't replace losses, you need to really, really, really do your due diligence. Take a look at this asset up front, backwards, and sideways. Who are the principals? Talk to other people who've invested, and do your due diligence and your homework before you invest. So what are the limits? When the IRS created IRAs in 1974-75, they didn't tell us what we can put in an IRA. They only told us what we can't put in an IRA, and that would be life insurance contracts and collectibles. Now, I would also add shares of an S corporation to this as well, and that's not because of the IRS, but because S corporations don't allow non-humans to invest in them. But, excuse me, an IRA could make a note to an S corporation, just not own stock. So really, very few limitations of what you can invest in. The real limits are indicated by the custodian as to what is administratively feasible. So say you think this is a great idea, because it is, and let's self-direct. Let's do it right now. And you think, oh, well, I've got this money that's sitting in my current employer's 401k. I'll use that. Well, the truth of it is, if the money is with your current employer, you probably will not be able to move that money over to self-direct. You pretty much have to wait until you leave the service of that company. Now, what you can do is you can go to your company's plan administrator, and you can request what's called an in-service transfer. You can ask the plan administrator, I'm in service, I'm working here, can I transfer some of this money out to an IRA? And if the answer is yes, then you can move forward. So no good conversation about self-directed IRAs would be complete without a good discussion of the rules. And some of the rules can be found in the Internal Revenue Service publication 590. You can find that on the IRS's website, which is irs.gov, irs.gov. Look up publications 590A and 590B. They've been enhanced over the years to add more and more information about IRAs, including prohibited transactions, which we'll get to in a moment. But what they say is that there's no borrowing money from the IRA. You can borrow from a 401k, but not from an IRA. You don't use your IRA to sell property you already own into the plan. That doesn't work. You don't use your IRA as security for a loan, and you're not going to use the IRA to buy property for personal use, whether present or future. Okay, so we've talked about what you can do, a little bit about what you can't do. Keep in mind that some people are qualified and some people are disqualified to the IRA. So the disqualified people are your lineal ascendants and descendants. So your parents and your grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses are disallowed. Plus anybody, maybe like if you have a 50-50 business partner, they can be considered disqualified, or anybody offering services to the plan. They're disqualified people. Now the qualified people are the people out to the sides on your family tree, like aunts and uncles, cousins, brothers and sisters, nieces and nephews. These people are qualified to invest with and basically benefit from your IRA. So the self-directed IRA game really is a game of keep away from prohibited transactions. It's also a game keep away from, from losing your investment, of course. That's why you do your due diligence. But what we want to make sure is that you follow these rules so that you obey the IRS's guidelines and have a good experience. So neither you nor any other disqualified person can benefit from the IRA today. That's a prohibited transaction. You're not allowed to have personal benefit, present benefit, indirect benefit. Number two, an IRA cannot buy, sell, or exchange assets between the plan, the IRA, and any disqualified person, and that includes you. And number three, a disallowed person can't provide goods, services, or facilities to the plan. So say, for example, you as a disallowed person could not offer services to the plan, for example, by painting the walls or by, maybe replacing the electrical work or something like that. So no over-contribution of sweat equity there. Now, if you're going to play a game, you need to know who the players are, right, if you want to win. So in the IRA game, the self-directed IRA game, the players are you on the one hand and your IRA on the other hand, because it's not you investing personally. It's your IRA investing as its own entity. Then there's UDirect IRA Services. And when I founded this company, I formed an alliance with a trust company custodian to hold our clients' funds. So UDirect IRA Services is the point of contact for everything regarding your self-directed IRA. Now let's talk about using the self-directed IRA to buy real estate. Now the pros are that the money that comes in, the gains, the cash flow, is tax-free in a Roth or tax-deferred in a different kind of account. There's no time limit for holding the property. You could hold it for a day or a year or a week or 10 years or 100 years. I mean, if you live that long, I hope you do. There's no time limit. An IRA can actually borrow money too, and we'll discuss that. Plus, there's a potential to earn a larger rate of return on your invested capital. Why? Because, say, for example, you've invested and your investment increased, say it's a house, and now it's $100,000 more. You sell the house, and now here come all the proceeds from escrow, and they land in your IRA. Well, those proceeds are not diminished by tax. It's in a tax-free, tax-deferred environment. So you can take 100% of that capital, that return, and put it back out to work in your next deal. So you compound faster. Now, the downside about buying real estate with your IRA is you don't get those normal tax write-offs that you would if you owned real estate personally. So you don't get to write off, visiting the property. You don't get to write off traveling to it, which is the same as visiting. You don't get to take the normal deductions that you get, like writing off interest and things like that. Of course, you are solely responsible for all gains and losses. It is self-directed. So your role in the self-directed IRA is you're the expert. You're the investment expert. So you need to make sure you don't commit any prohibited transactions. You need to make sure you do your due diligence and choose a good asset, because if you were to stumble into trouble, then you would be solely responsible for that situation. Now, you can't replace losses either, so be real careful. Important to know all sides of the coin using a self-directed IRA. Now, I did mention earlier that your IRA can borrow money, and it can, but it needs to be a non-recourse loan. So what's that, right? Well, it's a special kind of loan. You don't just go to your bank or your mortgage broker and get one of these. I do have a listing of non-recourse lenders. If you'd like me to send it to you, I'd be happy to, and you'll find my contact information at the end. So it's not a loan made to you, the person. It's a loan made to your IRA account. And if your IRA were to default on that loan, the lender could only come against the asset, the house, or the piece of real estate that you've invested in, not against your personal assets, and not against any other assets inside the IRA. So the only recourse is a subject property. Now, with these non-recourse loans, there are only a few lenders to choose from, not very many. They will require more skin in the game. 40, 45, 50, 60% of the loan to value is going to come from your IRA. And of course, you cannot personally guarantee the loan to an IRA, because personal guarantees are not permitted. They're prohibited transactions. And that's because you as a person would be adding, value. You'd be providing a service to the IRA, and that's a prohibited transaction. Now, it's really important to understand about self-directed IRAs is that there are two ways that an IRA can be taxed. We've talked about the IRA being a tax-free or tax-deferred environment, and that's true unless your IRA borrows money. If your IRA takes on one of those non-recourse loans, the proceeds received because of leverage are taxable. Now, you want to discuss that with your tax advisor. It's called UDFI, Unrelated Debt Financed Income Tax. The other time an IRA can be taxed is when that IRA has invested in an active business. That's called UBIT, Unrelated Business Income Tax. Great conversation to have with your tax advisor before you move forward. You can read about this at irs.gov, publication 598. So these UBIT and UDFI taxes are reported on a Form 990T. So when you and I do our taxes, we report our personal taxes on a 1040. When your IRA owes tax, it reports that income tax on a 990T. Okay, so buying real estate with your IRA, how does it work? The first step is open an account. And I say that because so often we get the phone call that someone has already put a property under contract. Now they want their IRA to buy it. Well, your IRA cannot buy a piece of property if you don't have an IRA. And of course, it's not you buying the property, the IRA is buying the property. So if you've already signed the contract, you have to exit that agreement and enter into a new agreement that shows the name of the buyer, which is the custodian for the benefit of your IRA. We sign on behalf of the IRA, not you. So you open the self-directed IRA. It takes a couple weeks to move your money into it from a current custodian. We're going to be waiting on this third party to move your money in. So open it, get it funded, then shop for a property. Remember, the IRA is the buyer. So it's the custodian for the benefit of, or we say FBO, your IRA. And then we sign the offer to purchase. So you give us a direction letter. It's our simple one-page form. You give us the supporting documentation, and then we review it. And then ultimately your funds are wired. You fund, you close, you record. And then once your tenant moves in, rents are made payable to the custodian for the benefit of your IRA. So this is a good time to bring up turnkey situations, which are ideal for IRAs where someone else is taking care of all these things for you, the collecting of rents and so forth. Because remember, you can't do the repairs on a property that your IRA owns because that would be a prohibited transaction. You want to keep everything arm's length in an IRA. So your IRA, your tenants can make their payments to the IRA, or they can make their payments to like a property manager. And so a property manager can really be an IRA's best friend in this regard. Now here's an example of someone buying real estate in their IRA. We have a father and a son, and they're going to buy a house together. Now I did tell you that fathers and sons are disallowed. They're prohibited to one another, but this is an exception to the rule. So dad is using cash. The son is going to use his traditional IRA. Now if you're partnering with somebody using a self-directed IRA, you partner from the beginning, and your pro rata share is a pro rata share from the beginning all the way through the deal. So in this case, the title would read, the custodian for the benefit of the son's IRA, 50% owner, dad 50% owner, tenants in common. So aren't they disqualified? Well, no, because if before the deal, the father had no ownership interest in that property, and the son nor his IRA had any ownership interest in the property, then it's because it's a new deal that disqualified person rule doesn't come into effect until they actually close, until after the deal. So now they've closed, their names are on title, and neither one of them will have any personal use. They're not allowed to live in there. They're ascendants and descendants, disqualified people can't live in there or have any use. And if your IRA owns a property, you can't stay in that property for even one day. Those are the rules. It's for investment purposes only. So after the deal, neither the father nor son can ever buy each other out either because they're disqualified to each other. But I was explaining that pro rata split. So all expenses are split pro rata. In this case, it's 50-50. It could be whatever, 60-40 or what have you. But in our example, we're saying 50-50. So earnest money, closing costs, rehab costs, property tax, a new roof, whatever, all of these things will be split pro rata. In this case, 50-50, each person paying their share. Similar to proceeds, here comes a rent check, you fixed up the property and now you've sold it, now you get money from escrow. Any proceeds that come back into the IRA or that are due to the IRA are split this way. So everything would be split pro rata. So all expenses of the IRA-owned assets must be paid for by the IRA. You just don't ever write a check out of your personal account and pay an expense for an IRA-owned asset, because then you'll pierce that veil of the IRA, right? I mean, you'll create a prohibited transaction. So you don't put your personal money into an IRA deal. So what if the IRA depletes its reserves? What if there's not enough money? What if a property tax bill comes due and you don't have enough liquid cash in your IRA to cover that expense? Well, here are some things you can do. Number one, you can write a check and make your annual contribution to your IRA. How much? Well, that depends upon your account type, your age, and your income. So you want to talk to your tax advisor. Number two, you could liquidate other assets in that IRA. So maybe your IRA owns some gold bullion as well as a house. So you might liquidate those metals and get the cash in the IRA and use that cash to make up the shortfall. You could transfer money from another retirement account. Say you've got stocks, bonds, and mutual funds across the street. You sell them, you liquidate them, you transfer the money in. That'll take about 2 weeks. Your IRA could bring on a partner as long as they weren't disqualified, and the IRA could borrow money. Or if all else fails, you could just sell the asset. These are the things that you can do. Now, there is another way of investing using an IRA, and it's commonly called a checkbook IRA, which is a terrible name. It's very misleading. It's not a special kind of IRA, and just because you opened a self-directed IRA does not mean you get a checking account. What this really is, what it should truly be called, is the IRA-owned LLC. So you have a self-directed IRA, right, and there's money in it. Then your IRA buys 100% of the initial shares of an LLC, a special purpose LLC with special language. And then you get to use the checking account of that LLC to invest. Now, you have to follow all the same rules for IRA investing. And the opportunity to commit a prohibited transaction without our eyes looking at your deals is pretty high, so you have to make sure that you're very careful. But it is a tool that you are presently allowed to use. So there you go. Now, what kinds of plans can be self-directed? We call it the self-directed IRA. It's kind of an umbrella term for everything, but all of these kinds of plans can be self-directed, including an individual K, or a solo K it's sometimes called, or a 1K. So this is a 401K that's for a single business owner who doesn't have any full-time employees in any of the companies that they own. All right, that's how that works, and there are a lot of bells and whistles for that. But all of these different kinds of plans can be self-directed. The traditional Roth, SEP, simple, spousal, inherited IRAs, all self-directable. So how do you do this? How do you self-direct, right? Well, it's a three-step process. You complete an application on our website, and so you give us a copy of your driver's license, a copy of the statement where the money is coming from. We need, there's a $50 setup fee. So you open the account. Step two, you fund that account. You put money into it in one of three ways: by writing a check and making a contribution, by doing an IRA to IRA transfer, or by rolling over a previous employer's plan. And then after your account is open and funded, you tell us what you want to invest in. You give us a direction letter. You give us the supporting documentation. We review, and if there are little issues, we'll let you know. And we get it all cleared up, and ultimately you fund, and then your IRA has invested, and now your IRA owns an asset. All proceeds must come back into the IRA that owns the asset, and all expenses must be paid for from the IRA. That's how that works. So if you'd like more information, I'd be very happy to help. Shoot me an email, khall@udirectira.com. You can reach me at this toll-free number, 866-538-3539. Or come visit us in Irvine, California if you want. So with this, I turn things back over to Veronica. And Veronica, thank you so much for letting me be part of the event today. Thanks so much.
You're welcome, Kaaren. Excellent information. Thank you. So just to wrap up and finalize, you have an excellent wealth building strategy at your fingertips. I'm here to help you. Kaaren is here to help you. And I invite you once again, to go to veronicasaldivar.com/discovery so you can sign up for your discovery session now. Again, I appreciate your time. Thank you for being here, and I look forward to speaking to you very soon.